Okay, so we're going to continue with IES 8. We are solving questions. In the previous video, we solved questions on errors. We solved questions on changes in policies, right? In this video, we are going to solve questions on changes in accounting estimate. Changes in accounting estimate, right? As we learned in the first video, changes in accounting estimate are treated prospectively. They are treated prospectively. So we start the change, right, from the very year, from the very day the change occurred, and the subsequent years or the subsequent periods affected by the change, right? So change in estimate is treated prospectively. That we start from the year in which the change occurred or the period in which the change occurred, and then subsequent periods or years, right? Good. Let's look at this question here. Let's look at this question. So question 7. Question 7 says, Paga Limited was incorporated on 1st January 2012 and follows IFRS in preparing its financial statement. In preparing financial statement for financial year ending December 31st, 2014, Paga Limited used these slides for its property, plant and equipment. So building 15 years, plant and machinery 10 years, furniture and fitting 7 years. On 1st January 2014, the entity decides to review the useful lives of the PPE. For this purpose, it hired external valuation experts. These independent experts certify the remaining useful lives of the PPE of Paga Limited at the beginning of 2014 as follows. So buildings 15 years, plant and machinery 10 years, and then furniture and fittings 7 years. Paga Limited uses the straight line method of depreciation. The original cost of the various components of the PPE were, so the cost of building 50 million, plant and machinery 10 million, furniture and fittings 3,500,000. And the requirement is calculate the impact on the income statement for the year ending December 31st, 2014 if Paga Limited decide to change the useful lives of PPE in compliance with the recommendations of the external valuation expert, right? So there has been a change in accounting estimate. They've changed the useful life, right? Paga Limited hired external valuation expert and they changed or they revised the remaining useful life of the PPE, right? Okay, now let's go back here. If you check, we have two useful lives. Okay, we have up here and then down here. Right now, if you check, you realize that they are the same. Building 15 years here, 15, plant and machinery 10, 10, furniture and fittings 7, 7. This is coincidence, right? You can see it's coincidence. The values here, okay, those up here are the original useful life of the PPE because we're told that Paga Limited used these lives, right? They use these lives. So these ones are the original lives of the assets. Okay. Then when you come down here, these ones here are the revised or the remaining useful lives as at 1st January 2014. Right. So these ones here are the revised remaining useful lives, right? As at 1st January 2014, right? So these ones are the remaining useful lives. Okay, it's coincidence that the remaining useful lives, the coincidence that the remaining useful lives were the same as the original cost, the revised useful lives. But you just have to know that when you are computing depreciation, because the lives were revised in 2014, okay, when we are computing depreciation for 2012 and 2013, we are going to use the original cost. This one's here, this one's up here. These are the ones that we are going to use when we are computing depreciation for 2012 and what 2013. Then from 2014, you have to come and use these ones here, the revised ones, because the revision happened on 20 it happened in 2014. They revised the lives in 2014, right? So we are computing depreciation for 2014. We are going to use those below, the ones below here. Okay, so as simple as that. Then we have the cost to here. We have the cost of the assets here. Now you'll realize that to get the depreciation for 2014, okay, we need the carrying value as at 2014 and we divide by the remaining useful life. Okay, so we have to start depreciation for 2012 and 2013 before we can get the carrying value as at 2014, right? 1st January 2014, and that's what we are going to use to calculate the um depreciation. So we will need the carrying value as at 1st January 2014, right? And that's what we are going to use to calculate depreciation for 2014. So depreciation for 2014 will be the carrying value, okay, divided by the revised or the revised remaining useful life. The revised remaining useful life, right? So let's start depreciation for 2012 and 2013. So let's pick them one by one. Let's pick the first item. So the first item is building. Okay, so picking building. So let's deal with building. When we pick building, the accumulated depreciation for building is we pick the cost. So accumulated depreciation, right? So we said we are going to pick the cost, which is what? If you come down here, you see a 50 million for building. So that will be a 50 million divided by the useful life, the top one, this 50 million. Sorry, this 15 years. Okay, so that's what we are going to divide by the 15 years. So 50 million divided by 15 years will give us something like 1 million. By for 2 years, for 2012 and for 20 what 13, right? So we can multiply it by 2. So by 2. Okay, and this accumulated depreciation here is from, okay, we can say from 2012, okay, to 2013, to December 20 what 13. Okay, and then that's what will give us 2 million. So we have 2 million as accumulated depreciation for 2012 and what 2013. Good. When we come to 2014, okay, we need to get the carrying value. So as at 1st January 2014, okay, so 1/1/2014, what is the carrying value? The carrying value will be equal to the 50 million. That's the cost, right? The 50 million cost minus the accumulated depreciation we've calculated, and that's 2 million. So minus 2 million, and that will give us 13 million. So 30 million is the carrying value as at 1st January 2014. Okay, so if you check depreciation for 2014, okay, so depreciation for 2014, depreciation for 2014 will be the carrying value, okay, the 13 million carrying value divided by the remaining useful life. Don't forget. Okay, now we are back at 2014. So 2014 building, we are going to use the revised, this one here, the revised 15 not the top 15. I said it's coincidence that the original is a coincidence that the original useful lives were the same as the what, or the same as the revised remaining useful life. Okay. In other cases, they'll be different. What you have to do, you have to use the remaining useful life. Okay. When you are calculating depreciation for 2014, that is the year in which the change happened. Okay, so we have to use the 15 and it's remaining. So we are going to use the whole 15. If we were told that the revised useful life, okay, is 15 years in total, then you have to go back and deduct the depreciation that you've computed. So let's say in this same question here, this 15 years here is the revised total useful life. Would have deducted the 2 years depreciation that we charged. Okay, would have deducted the 2 years depreciation that we have charged. Okay, and that would have been 13. So that we use what? 13 years. If the 15 years here is the revised total life, would have deducted the previous years that we charged depreciation from it. So would have taken the 2 years from it. But I said these are remaining, right? So to get depreciation for the subsequent years, as we said, it is the what? The carrying value divided by the remaining. So we have 13 million, 30 million divided by 15 years. Okay. And then that will give us 866,666.67. Okay. So this will be depreciation for 2014. And then the carrying value at the end of 2014 will be the 30 million minus 30 million minus the depreciation, the 866 comma 6667.67, right? Would have been this, the remaining, the 30 million minus the 866.67, and that would have given us, or that would give us a value of 12,000, sorry, 12 million 133,333.33, right? So this is a value that we are going to record in the statement of financial position as the value for the building. When you go to the next item, so the requirement is we calculate the income and the impact on the income statement, right? So in 2014, we have to charge depreciation of what? This figure in the P&L account. Let's pick the next item, which is plant and. So we have plant and machinery. Okay, so with plant and machinery, the same thing here. We are going to follow the same thing. We charge depreciation for 2012 and 2013 using the old life. Okay, so let's get the accumulated depreciation, and the accumulated depreciation will be for 2012 and 2013. So we pick the cost plant here is 10 million divided by the life here 10. Okay, so we have 10 million divided by 10, and that will give us 1 million, but we can multiply by 2. So this is for 2 years. So multiply by 2, and then we will get 2 million. So 2 million is the accumulated depreciation for 2012 and 2013. Okay, then let's get the carrying value as at. So this will be the carrying value, okay, as at 1st January 2014. We will charge depreciation for 2012 and 2013. So as at 1st January 2014, the carrying value will be 10 million, right, minus 2 million, which gives 8 million. So 10 million minus 2 million, and that will give us 8 million, right? So that will be the carrying value as at 1st January 2014. Okay, so we have 8 million. Then we charge depreciation for, so let's charge depreciation for 2014. So depreciation for 2014 will be the remaining life, which is, I'm sorry, depreciation for 2014 will be the carrying value, which is the 8 million, then divided by the remaining useful life. Here in this question, once again, total life is what, 10 years? Okay, we've charged 2 years depreciation. We've charged depreciation for 2 years. So it would have been left with what? 8 years. Are you following? Would have been left with what? 8 years. But the question said the remaining is what? 10. So we have to use the remaining 10. Okay. And I'm saying if we are told that the revised life, these lives here, this revised useful lives here are total, we would have taken the previous amount, okay, or the previous year's depreciation from it before we calculate. Because to get the current value or to get the depreciation, it is the current value divided by the remaining life. Okay, so sometimes if you are doing changes in the estimate, the question will give you the revised total life. So if the question gives you the revised total life, they have to go back and deduct the previous years that charge depreciation from the revised total life. Okay, so we deduct this one, and here we will get 800,000. Okay, so the current value will be the 800,000. You go and take the 800,000 from the 8 million, right? So the current value will be the 8 million divided minus. So we are going to have the 8 million minus the 800,000, and that will give us the current value, which are going to record in our financial position. So that will give us 7,200,000. So that's it. So for 2014, we are going to record depreciation of what? 800,000, because we are looking at the impact on the P&L, on the income statement that the question said we should do. Then let's go and look at furniture and fittings. Okay, so for furniture and fittings, the same thing, you have to add accumulated depreciation for 2 years. Okay, accumulated depreciation for 2 years. That is for 2012 and then 2013. Okay, so what's the cost of the asset? Furniture and fittings, the cost is 3,500,000 here. So we pick the cost 3,500,000. Then we divide by the total life here, 7 years. So we divide by 7, and that will give us a figure of, well, we have to multiply by 2 because we are doing for 2012 and what? 2013. Okay, so let's multiply by 2, and then that will give us 1 million. So 1 million is the accumulated depreciation for the 2 years, right? Then we can now get now that we have the accumulated depreciation, we can get the carrying value. And this carrying value is as at 1st January 2014. Okay, and that will be the cost of the asset. That's the 3,500,000 minus the 1 million, right? And then that will give us 2,500,000. So 2,500,000 is the carrying value as at 1st January 2014. Now we want to charge depreciation for 2014. Okay, depreciation for 2014. So depreciation for 2014 will be the carrying value, that's the 2,500,000 divided by the remaining useful life. Okay. And the question said the remaining useful life is what? 7 years, as given by the experts, right? It says they said the remaining useful life as at the beginning of 20 what? 14. So the remaining useful life is 7 years, which is also the same as the original cost, which is the same as the original life. Okay, which is the same as the original life 7. Okay, so we have to divide 250 by 7, and that will give us 357,142.86. So this is depreciation for 2014. Okay, this is depreciation for 2014. So the carrying value of the PP of the furniture and fittings, the current value as at the end of 2014 will be the 2,500,000 minus the 2,500,000 minus the 357,142.86, right? Okay, 86. And then this, what we'll get will be the current value as at the year end. Okay, very good. So we are going to get 2142,857.14. So this is the current value of the furniture and fittings in our books, and this will be the depreciation that we are going to charge for 2014, right? So that is it. That's it. It's not difficult. It's not difficult. Okay. What you have to know is that if this remaining life, the remaining life here, the remaining life that we have there, if we were told that it was the revised total life, okay, this 15, 10, and then this 7 here, if they were the revised total life, they would have taken the two depreciation for the 2 years. So we would have taken 2 years from it, and we'll be left with the building would have been left with 13. So we have divided by 13, and then plant and machinery would have divided by 8, and then this would have divided by what? 5. But they said the remaining life is what we have there, right? So this is it with question 7. We've been able to determine the impact on the income statement for 2014, and I said the impact on the income statement is only the depreciation. Okay, and that will be this. So these are the figures that I'm going to record in the books. Let's end here with question 8. Let's end with question 8. Question 8 says a non-current asset was purchased for 200,000 2 years ago when its expected economic life was 10 years and its expected residual value was nil. The asset is being depreciated by the straight line method. A review of the non-current asset at the end of year 2 revealed that due to technological change, the useful life of the asset is only 6 years in total, and therefore the asset therefore has a remaining useful life of 4 years. What is the depreciation charge for year 2 and the carrying amount of the asset at the end of year 2? So as we've done, we said the change, the year in which the change happened. When we are charging depreciation, or when we are charging depreciation for that year, the year in which the change occurred, we are going to use the revised useful life. Okay, we are going to use the carrying value divided by the revised useful what life, or the revised remaining useful life. Here in this question, they purchased the asset 2 years ago. They did a review in year two. It says this is a review of non-current assets at the end of year what two. So the change happened in year two, and in year two they said the revised life of the asset is not six, and sorry, they said the revised life of the asset. So they said the revised life of the asset is what 6 years in total, not 10. So when you get your current value, you have to less the years, the previous year that you compute depreciation. You have to less it from the six before you calculate depreciation, and for before you calculate depreciation for what year two. And here the change happened in year two. So we are now going to charge depreciation in year two. We are here to charge depreciation in year what two. So we charge only 1 year depreciation for year one. Year two, we are here to charge depreciation. So with accumulated depreciation, okay, and this is depreciation for year one. So let me even make it better. Let me name it. Let me make it depreciation for year one. So depreciation for year one. So for year one, we are going to use the original life because the change happened in year two. So we have 200,000 divided by 10, and then that give us 20,000. That should give us 20,000. So the 20,000 is depreciation for year one. So current value at the end of year one will be the 200,000 minus the 20,000, and that will give us 180,000. So 180,000 is the 180,000 is the current value at the end of year what one. So accumulated depreciation will only be for year one. Then when you come to year two, okay, when you come to year two, so with depreciation for year two. Now, year two is when the change happened. Okay, so we are now going to charge depreciation for year two. So the accumulated depreciation will be for only 1 year. Will be for only one what year, right? Because we charge depreciation for the accumulated depreciation will only be for 1 year because it is year two that we are doing the revision. So we've not charged depreciation for year two yet. We are yet to charge depreciation for year what two. And depreciation for year two, we are going to charge depreciation for year two using the revised life. We are going to use 6, not what the 10. So what you have to know is that if a change happened, if a change in estimate happened, you have to, and you are calculating depreciation for that year, the year in which the change happened, you have to use the new revised life of the asset in the year in which the change happened. So here the change happened in year two. So when you're calculating depreciation for year two, you have to use the revised life. So as I said, before year two, accumulated depreciation is for only 1 year. Don't be mistaken and go and charge accumulated depreciation for 2 years before you get the current value. You'll be wrong. We are here to charge depreciation for year two, and the change happened in year two. So the year in which the change happened, you have to use the new life in that year. So if you charge accumulated depreciation for 2 years before you deduct and get the current value, you get 160,000 the current value. You are wrong. The change happened in year two. So we have to calculate depreciation in year two using the new life, the 6 years. So when it comes to year two, the depreciation for year two will be what's the current value? 180,000 divided by the remaining life. Now, we're told that they said they have revised the remaining life. If you check, the total life of the asset when it was purchased was what 10 years here. It was 10 years when it was purchased, right? Then we charge depreciation for what 1 year for year one. So in the normal circumstance or in the normal case, when charging depreciation for year two, it should have been the 180,000 divided by what 9. But they said they have reviewed they have what revised the total life from 10 to what 6. Okay, and we said to charge depreciation, it is what the carrying value divided by the remaining useful life. Carrying value divided by the remaining useful life, right? What the remaining useful life? They said now the revised life is what 6 years, right? 6 years. But we charge depreciation for 1 year, so 6 minus 1. So we are going to divide the 180 by what 5. Then they said the asset therefore has a remaining useful life of what 4 years. So see, after we are done charging depreciation for year two, after year two, it will be what 4 years, because year one we charge one, year two 1. So after year two, the life will now be what 4. So from the beginning of year three, or from year three going, if you are going to charge depreciation, then we divide by what 4. Don't be confused with the 4 years here. The 4 years they brought. They said after your change in year two, the remaining life will be what 4, and it's true. Okay, so don't use the 4 in year two. If you divide the 180 by 4 years, you'll be wrong, because they said the remaining is 4 years. So you divide by the remaining. The remaining 4 years there is after year two. Are you getting it? But we are yet to charge depreciation in year two. So we've not charged depreciation for year two yet. So we don't have to use the 4. Okay. After we are done charging depreciation for year two, then the remaining will now be what the 4. But in year two, we are yet to charge the depreciation. So it will be what 180,000 divided by 5 years. Okay, that's 6 minus 1. And that will give us depreciation of what 36,000. Hope I'm right. 36,000 for year two. So the current value will now be the 180,000 minus the 36,000, and then that'll give us 144,000. So 144,000 is the current value at the end of year two, and depreciation for year two is 36,000. 36,000. Good. So that's it with this. Be very careful and understand. Don't confuse yourself. Just practice more questions and make sure you understand. But we said that with the change in estimate, okay, the very year in which the change happened, is the year in which we are going to reflect the change. Okay, so if here in this question the change happened in year two, so we are calculating depreciation for year two, we have to use the new revised life in year two. That's all. If you look at the one we solved here, questions, if you look at question 7 that we solved here, it was the same thing here. Okay, we calculated depreciation from 2012 to 2013. And in 2014, that the change happened. We use the new lives. Are you following? We use the new lives here to calculate depreciation in 2014, because that's the year in which the change happened. The same thing here. The change happened in year two. So we are charging depreciation in year two. Use the new life. Okay. So our accumulated depreciation will be for only year one. As I said, the question mentioned 2 years ago. So you might also go and calculate accumulated depreciation for 2 years before you less and get the carrying value. No, the change happened in year two. So you have to get the carrying value at the beginning of year two. Okay. And your depreciation in year two, the year in which the change happened, will be based on the new revised life. Okay. And I said again that if they have given you the total remaining life, if they give you the remaining life, it's fine. Divide your carrying value by the remaining life. But if the question gives you the total revised life, as we have in question 8, question 8 gave us the total life to be 6. So we deducted the 1 year depreciation we charged, and we got 5. The question for question 7, they have not given us the total revised life. They've given us the remaining. So we use the whole remaining. So if I given remaining life, use the whole remaining. Just divide the current value by the remaining. But if you are given the total revised life, divide that total and subtract the previous years life charge depreciation from the total revised life, and that will be the remaining life you are going to use. So if they revise the total life of the asset, okay, and the question gives you the total revised life, go and deduct the previous year's depreciation you've charged. How many years have you charged depreciation? You've charged depreciation for 3 years, 4 years. Deduct that previous years that you've charged depreciation, the number of years that you've charged depreciation from the total revised life. Then you get the remaining. But if you're giving the remaining revised life, just divide, just use it straightforward, and that's it. Right. So that's it with IAS 8 accounting policies, changes in accounting estimates and errors. So we've been able to cover a lot. We solved approximately 9, 10 questions. We solved questions on errors, questions on changes in estimate, and then questions on changes in what accounting policies. Right. So check those videos out, and then you practice, solve more questions, and then you'll be good to go. So we are going to draw the curtains on IAS 8 here. Well, along the line, we'll be solving questions, and then we will be solving questions along the line. Okay, but for now, we're going to pause here. Okay, so if you've not subscribed, please subscribe. I'll be uploading more videos, right? So subscribe to my YouTube channel. You can share with your friends so that they also benefit, right? So I'll see you in the next video.